Welcome to the Second Bite Podcast, where we talk with top entrepreneurs and CEOs about creating valuable companies through creative transactions. Now, let's get started with the show.
Hello, Todd Taskey here, your host of the Second Bite Podcast, where we have an opportunity to talk with top CEOs and entrepreneurs, perhaps that you have not heard of, that have created valuable businesses and have gone on to complete successful transactions with those businesses. And today I have a repeat guest, Dr. Jeremy Weisz from Rise25. Jeremy has done thousands of interviews with other CEOs and influencers. And today we are going to have Jeremy interview me a little bit and talk about the year that has passed and some of the highlights from that year. Jeremy?
Todd, thanks for having me. It's always a pleasure to learn from you. And yeah, we're going to do a year in review episode here. We go through some of the lessons you learned, some great stories from the podcast, from the Second Bite podcast. Before we get into it, this episode is brought to you by Potomac Business Capital. And, you know, what they do is over the past 15 years, he's perfected their strategies for M&A advising and exit planning to guide clients through everything from pre-deal planning to closing. And you can learn more at potomacbusinesscapital.com. or email Todd at potomacbusinesscapital.com. And of course, check out the Second Bite podcast. It's very popular. People love it. And if you're looking at this, what we're looking at is the podcast view page. And we're going to start off with Scott Bell. And Scott Bell went from college entrepreneur to Inc. 500, CEO of High Level Marketing, which is a fully integrated agency. And Todd, what did you like about Scott's story?
You know, first of all, Scott was the CEO of Bell Media. And we did a transaction with Scott in March where he acquired my client, High Level Marketing. And he talks about how he built his agency. I met Scott because we almost did a transaction for him with the private equity group. And we got down to a couple last points that Scott just didn't want to budge on as it relates to value and cash at close. And he did not sell to private equity. And an opportunity came up to put him together with High Level Marketing. There's a bunch of reasons why those two businesses fit well together and probably belong together. And it's really interesting because in Scott's episode, he talks about the buyer's perspective, what they look at, the things that they're attracted to, and then further talks through the process of getting a transaction done. And I think it's helpful for entrepreneurs to get some insight into the buyer's mind when they do a transaction. And then just a couple of weeks ago, we'll be posting the episode soon, we interviewed Wes Matthews, who is my client, the CEO of High Level Marketing. And so it's a great perspective when you can hear both parties talk about the transaction. And what you'll hear is that both parties really wanted to get a transaction done. Both parties had really important things to them and then less important things to them. And you get a pretty good view into how we're able to work through a transaction and better understand how you can put two pieces together really well to form a great relationship and a great business going forward. And so Bell went on to acquire the business. They also kept the name High Level Marketing. And we closed the deal the last day of March. They outperformed their projection for the balance of the year by almost 20%. So in just the first year, they're seeing a lot of the synergies that they were hoping for, both on the revenue and on the EBITDA line.
What are some of the sticking points that you see in general? You mentioned, cash at close. What are some things that kind of hold things up or people kind of dig their heels in on typically?
It's interesting, and Wes really does a good job talking about this. The seller gets nervous, right? They're taking a big step. They're making a big commitment when they sell their business. And sometimes they just feel like things aren't fair or aren't right, or they're giving too much or they're not getting enough. And so Wes talks about that. That's really sticking points often come down to perspective around some certain things. In this particular deal, we spent a lot of time talking about working capital, which is something we talk about quite often with clients. That was a little bit of a sticking point here. But it's interesting because you'll hear from Weisz that he knew right early on that this was exactly what he was hoping would be the next step in terms of the evolution of his business. And so he was excited for the transaction, but wanted to make sure that it was a fair transaction. And I will say it illustrates pretty well the role that we oftentimes play, which is being that mediator in between, the buyer and the seller, so that after a pretty thorough or aggressive negotiation, parties can still like each other without a lot of baggage being dragged into the relationship.
Yeah, that makes a difference because then they're not directly talking to someone, I imagine, when things get, I don't know, heated, but, there's maybe some sticking points. That makes sense.
Yeah, it definitely does. And remember, a lot of time our guys it's a first transaction for them. So they're not completely sure what is common and what's usual and what's expected versus what's not. So, getting a balance from somebody that they know is on their side with their best interest in mind is I think, very helpful.
Yeah. Let's go to the next one here. We have Jamie Elias, Insider View of Private Equity. And it's one of the oldest private equity firms in the US. And I'd love to hear what you liked about this one.
Yeah, so I would say to anybody listening, this is one certainly worth going back and listening to. So Jamie is a partner with Trivest. Trivest is, has done 300 acquisitions, 300 transactions in the 40 years that they've been in business. They're always on the list of family-friendly, founder-friendly private equity groups. And Jamie talks about, at an institutional level, how they view opportunities, why they make decisions, that there's some companies that they like and some companies that they don't, the personality traits that they find in successful entrepreneurs. And then Trivest itself has what they call their 3X process, because when they acquire a business, they assume that they're going to be able to triple the size of that company over a 3 or 4 or 5 year period of time. And they talk about some of the criteria and the reasons why they're successful. It was really, really insightful. As you see from the count, it went a little bit longer than usual, but that was a really insightful episode, hearing from an institutional buyer that does it repeatedly and looks at entrepreneurs and compares them side by side.
What's one thing that you remember, and it could be with Trivest or another company, that they really use to increase the value? Like, this is the path to 3X, right? So I don't know if there was something that they do that, that's a big deal, to 3X a company.
Yeah. Certain proven approaches that work. And, one of them, as I always recount it, the private equity playbook for growing a business is fairly straightforward. Number one, hire more salespeople. Number two, hire even more salespeople. Number three, expand your product offering or your service offering. And number four, somehow find really good people to execute on those plans. But, for example, when I talk to entrepreneurs and they're going to hire a salesperson, they're going to hire a salesperson, they're going to hire one person, and the money for that is going to come out of their pocket. When you talk to private equity, they're going to hire 3 or 4. They're going to build a sales process into a business, because they will have 1 or 2 by the end of whatever that cycle is. And then we're going to hire 4 more, and then more, and then we're going to grow a real. And for an entrepreneur to take that amount of risk and fund it themselves is something that almost never happens. So private equity, that's almost always their first step, right? Grow out a real robust sales process that works well and is repeatable over and over again.
Yeah. Love it. The next one is, you talked to how to ensure a successful transaction for your company with Michael Quint of Blue Text, and talk about Michael and what you liked about this one.
Yeah. So first of all, Blue Text, a great company. They're located here in Washington, D.C. They had 4 owners to that business. And they realized that there were certain things that they needed to grow the business more aggressively. And Michael talks about that. And one of the things that we talk about in this episode is that when we did the transaction, we focused a lot of their transaction on the amount of cash at close and how short we could make the earnout period. Because Michael was convinced that he was going to say a year or 2, and then he was going to move on to whatever was next. Well, when we had him on the episode, it was 4 years after we did the transaction. And he had talked about how he had just signed a 2-year extension on his employment agreement. And so he talks about post-close, how many of the things came true that he was hoping for with Eastport Holdings, who was the buyer. And he said, it's just much better here than I expected that it could be. And I think it underscores the importance of, as you know, many of the transactions that we do, particularly when we focus on the second bite of the apple, how important it is to find a really, really good strategic fit. Because this story, and Michael articulates it really well, but this story is one that I've heard from clients over and over again, because we had enough choice that the client made a really good selection on where they wanted to wind up, and it's benefited them long term.
Yeah, that's that's huge.
It has been for them. It's been a huge success for them.
The next one is sold twice, bought several. The remarkable story behind $100 million digital business, Matt Wilson. And this was Eastport Holdings.
Yeah. So first of all, Matt's a great guest to have. Super insightful, very thoughtful. He was the acquirer, he being Eastport Holdings. He drove much of that transaction, a lot of the negotiation around it. But Matt himself has built 2 agencies and sold them both. And now Eastport is well over $100 million in revenue. Yeah. So first of all, Matt's a great guest, right? Super experienced, very aware in general, very self-aware in particular. And so he was the buyer for Blue Text. And so that's always interesting when you can hear 2 people talk about the same transaction, like we spoke about with Bell and high level marketing. But Matt's also built 2 agencies and sold those successfully. And Eastport Holdings is a $100 million agency now. And you'll, as you listen to that, you hear how he thinks at a different level than he did when he was running a smaller agency. And it's a good illustration of how there's a pretty significant difference between running a business that's $10 or $15 million of revenue versus $100 million of revenue, and what businesses like that look for when they think about a transaction of a smaller agency.
Were they, I don't know if you talked to Eastport Holdings in this situation with Michael Quint and Blue Text or not, but were they looking for certain types of agencies to buy or a general agency?
Yeah, they were, they were looking in a sense to put together a few agencies that had a combination of recurring revenue and good data analytics capability set and a good customer list. And they had all those things, and they were able to help Blue Text with greater access to clients. And so that was certainly an important aspect of the transaction.
Got it. Yeah, I love hearing those stories. There's a couple of them with the buyer side and the seller side. So I encourage people to check them out on the podcast. And the next one is this one: how an unexpected knock at the door resulted in a fortune for two first-time entrepreneurs, Corby Wright and Mark Kovrig, senior advisors at Coforge, which is a global IT solutions company. What did you like about this one?
This is a great transaction, and I get to talk about this quite a bit. RuleTech was the company that they had. It's been renamed since. And it was bought by a public company out of India, a company called NIIT. And so my guys, Mark and Corby, wanted to do a transaction. People are excited by that. But they didn't want to be doing a transaction too soon in the evolution of their company. So we created a transaction that was built on a formula. And the formula approximately was, 7 or 8 times EBITDA for 60% of the value, and then about 2 times revenue for 40% of the value. So if you think about the formula, say it's 8 times EBITDA times 0.6 plus 2 times revenue times 0.4, that's the value of the business. In the transaction we did, the buyer acquired 55% of the company at close, then 12.5% the next year, 12.5% the following year, and 20% at the end of the third year, but based on the current year numbers. So they got paid a higher value for the business as they increased revenue and EBITDA. So they were incented in the right way. And you've heard me talk about this on past episodes, but a really good transaction, an evolutionary transaction, as we deem them, has to solve for the second problem, right? The first problem is always getting money, right? Getting the right amount of money and getting that at the right value. But the second one is kind of a fill in the blank. And the fill in the blank for RuleTech was access to larger clients and a global infrastructure, because they sold to large enterprise and they were a $10 million business, and that made global enterprise nervous. So from that perspective, being able to do a transaction that made them overnight part of a global enterprise, we had projected that they would do 20% a year in growth. And they did something like 27% the first year, 33% the second year. And then the third year, they got caught up in the end of COVID. It closed in May of 2020 was the end of the third year. So they still outperformed their 20% target but not by as much as we had hoped when we had originally considered 2020. But they were also quite thrilled that they had done a transaction, given all the aspects of COVID and the uncertainty of the technology and on from there.
That's pretty unique. Does that how frequent does that happen?
It depends on what the client is trying to accomplish. It's a little bit unique that the buyer is willing to do that on an unlimited basis, meaning that as big of an upside as you want to have. But they saw the wisdom in exciting these two entrepreneurs to really hit an upside, and they did a great job doing that. So it was a really neat structure. We've been able to accomplish a similar structure, maybe with different words and different formulas. But for all of our clients, the important piece is that there is significant upside, whether it's because they get equity in the larger company or they get an earnout or they get some combination of. That's what most of our transactions have in common.
Yeah. Love it. Next one is Advanced Ideas That Will Increase EBITDA This Year by Don and CPA partner at eCohen. What did you like about this one?
Yeah, first of all, Don's terrific. Don's been doing due diligence work for private equity buyers for 30 years. He knows them inside and out. He knows what they're looking for. He knows how to pull apart a QuickBooks report and then put it back together in a way that a buyer wants to see it. So Don's an important part of our team. They're located here in town. But Don, it's very interesting because when you go through a process, having reliable financials helps so much in negotiating a transaction, because we are very confident that the transaction we negotiate in an LOI actually winds up being the deal that we'll close on. And that's where deals break. Deals oftentimes break because somewhat less sophisticated sellers, smaller businesses, aren't completely accruing properly and are not fully gap based in all of their accounting. And so when that's discovered by a buyer, they're willing to, in many cases, honor the multiple that they've offered, but now the EBITDA number is different. And so Don talks very specifically. It was interesting. I had a CPA on, so I was hoping it would be an interesting episode, and it turned out to be 2 episodes, both of them full of things that entrepreneurs, to a certain degree, want to stick their head in the sand on, but turn out to be really, really good data points for entrepreneurs to think about and consider either before they do a transaction or as they're entering into a transaction.
What do you find, Todd, the one thing that entrepreneurs want to stick their head in the sand on?
It's what they want to stick their head in the sand on is the general idea of paying attention to all this nonsense, which is the accounting, and have it be gap based. As a quick example, I have a client. He just got paid $100,000 right at the end of the year in December, and said to me, "Well, that's great because it really boosts our EBITDA number quite a bit." And that's not the way accounting works. As I said to him, none of that, you haven't earned any of that $100,000. That's for probably a 3 or 4 month project. I said, so what you need to do is put the $100,000 down as revenue, and then put a deferred revenue on your balance sheet for $100,000. And then if it's a 4 month process, every week you'll earn $25,000 and you'll reduce the $25,000 on your deferred revenue on the balance sheet. To which he said to me, "I'm not going to do that." And not many small buyers do that, but that's the way that gap-based accounting is. And so if you're listening to this, you might say, "Well, I don't really care about that. It doesn't impact me." And to a certain degree, that's true, unless those numbers transition over the end of a year and spill from one year into the next. And oftentimes they do. And it does not always work against the entrepreneur. We had a transaction in 21 where, after Don went through his piece, there was $70,000 of additional revenue that came into the 2021 year, which was the year we were basing the transaction on, from 2020. So, if you think about a transaction, if it's at 6 or 7 times, that's $400,000 or $500,000 of additional revenue, of additional value to the company, because we understood the financials right. And that's one small example. And there's at least a handful more on those 2 episodes of specific things that Don would do to make sure that the books are right, but that any entrepreneur should be asking their accountant to make sure that they have done properly.
Love it. Next one is how focus plus focus equals outsized evaluation. Dean Dutro, co-founder of Worth e-commerce.
Yeah, Dean was a great transaction. Dean was smaller than what we typically do. Most of the transactions we do are over $1 million of EBITDA. Dean was a little bit south of that. But Dean had a really focused offering, right? They do email marketing for e-commerce customers. And so that was a very simple, easy story to tell. And we told that story to a bunch of different groups. One of them in particular was a company called American Discovery Capital out of California, a top flight private equity group with really good people working there. And they had a portfolio holding called SmartBug. And SmartBug wanted to add email marketing. They wanted to add expertise around the Klaviyo platform. And it was just a perfect fit. And for Dean, although he was small, it gave him the opportunity to get a little bit of liquidity, but he also got a very significant chunk of that transaction, almost half of that transaction, paid to him in stock in what is SmartBug. So for him, he's got what he believes is a much bigger upside, much better access to more clients. And for SmartBug, they've got, the next leg in the stool of what they want their service offering to be. So it's a really great fit.
Love it. Well, I encourage anyone, Todd, to check out secondbitepodcast.com. Listen to the episodes. They're a treasure trove of stories and lessons. And thank you for sharing this and for sharing the lessons from the past year.
Jeremy, thanks for joining me today. Thanks for recounting these stories. 21 was a great year, hopefully to be eclipsed by 22 as the world gets back into the direction that we want it to.
Thanks for listening to the Second Bite Podcast. We'll see you again next time, and be sure to click subscribe to get future episodes.